We do have with us the DG of the Debt Management Office, Dr. Abraham Wankwo. You're welcome to Sunrise Daily this morning.
Good morning, Mahope.
Yeah. Only recently you intervened on this particular matter on the back page of an article on This Day newspapers. And in that article, you chronicled how Nigeria currently needs about $25 billion per annum to fund the infrastructure. You said that we're $20 billion short in revenue earnings because of the failure of oil prices, and then we have a $45 billion deficit. Now, the federal government is looking to borrow $30 billion over a period. It looks like this doesn't even begin to address what it is that we need. But then it was seen that there's also been an advisory from the DMO that says that we shouldn't borrow more than $20 billion in 1 year, $20 billion as it were. Is that correct?
Great. Let me clarify. And actually, we've taken advertorials in the pages of Nigerian newspapers starting from yesterday. At least 4 newspapers did publish the advertorial to explain. I think there was that report by, Vanguard, sometime last week, which gave a wrong report on the situation. Now, the true state of affairs is this. The federal government has presented a medium-term rolling external borrowing program of about $29.9 billion US, call it 30 billion, approximately $30 billion US, for 3 years, 2016, 2017, 2018. That means that plan is for 3 years. So on the average, you are talking of about $10 billion US per annum. So that is settled. About $10 billion per annum is what the federal government is asking for National Assembly to approve.
That's on the average. It might be
that
more
is for
in
3 years. Yeah, well, that's the But the Debt Management Office, in their debt sustainability analysis published since September 2016, had advised government that you have a space to borrow as much as $22 billion per annum, starting from 2017. So if you advise that borrow a maximum of $22 billion for 1 year, and we have a medium-term borrowing program for $29.9 for 3 years, there's no contradiction. The $10 billion per annum that comes from $29.9 for 3 years is much below the $22 billion maximum for 1 year. That's one point. So that should be very clear. There's no ambiguity. And if you look at our debt sustainability analysis, this is very specific for 2017, 1 year. Federal government presentation is for 3 years, average of 10 per annum. However, it is even more important to go beyond that. People say there is a wisdom in government presenting a 3-year rolling plan instead of demanding for, requesting for just 1 year. We want to be forward-looking. We want to give everybody the opportunity to look forward, to plan. And therefore, instead of focusing ad hoc, every year you make a plan. You are taking off 3 years. So the federal government presented for a 3-year program. So we have a longer view picture of where we are going to. So that is very, very important to note. It's also very important to note that $29.9 billion for 3 years is for infrastructure. And you have to have a long-term, a relatively medium to long-term plan for infrastructure, so that Nigerians know how are we moving toward dealing with the infrastructure deficit. As you rightly said, even before the collapse of oil prices, it was well established, and Nigerians accepted about 5 years ago that we needed a minimum of $25 billion of investment per annum to cover the existing infrastructure deficit. With the collapse of oil prices, as you rightly said,
no,
public revenue is dropping
by about... I did not rightly say. I was quoting what it was that you...
Yeah, as you rightly quoted me.
Okay, just clarifying that.
If my estimate, based on what has happened, if you take the average per annum of public revenue that came from oil alone, let's say in 2014, 2013, if you take the average, and you compare to what you are getting post-mid-2014, following the collapse of oil price, you see that the public sector, the government, federal and states and local, are losing about $20 billion per annum. So you have to add this additional recession-induced gap to the existing gap that we all had established before the collapse. So that gives you $45 billion per annum. Now, so this gives you an idea of the size or the enormity of the challenge we have in terms of need to resource the economy. And you need to resource the economy very strongly, very boldly to pull ourselves out of recession. That is the obvious message. And so the $29.9 billion proposal, external borrowing proposal, which Mr. President had put in the National Assembly, is part and parcel of the whole idea of how do we get out of recession. To get out of recession, you have to fund infrastructure. When you fund infrastructure, you are building a base for the real sector to boom. You are talking of agriculture, so that those who produce tomato or potatoes in Kaduna and Katsina can move it along smooth roads all the way to Onitsha, to Lagos, to Port Harcourt, and get value for their money without their trucks and their goods collapsing on the way and perishing. That's the whole idea of how the economy works. You need to build the railways to save the roads from heavy loads, so that the very heavy truck should go along the rail.
We will come to infrastructure shortly, but then, let's talk a bit more about this $30 billion. You say, and you're certifying, you're Director General of the Debt Management Office, that with the federal government's plan to borrow $30 billion, we will not be in any trouble whatsoever. We're in order.
We are very much in order. Why? Why? First of all, you know that even on our existing debt stock, external debt accounts for about just 18%. Domestic debt accounts for 82%. That's one factor to note, that externally we are really virtually not borrowed. That had to be established. Secondly, is that the average cost of external borrowing is about 7% cheaper than average cost of domestic borrowing. That is the second point. The third point is that the more you focus on external borrowing, the more you leave more space for the private sector to have access to funds domestically. And this is critical, because if we are talking of reviving the economy, setting it part from downturn to recovery and sustainability, as government puts money in infrastructure, as government leads the way, as government builds the enabling environment, you expect the private sector to now play the lead role in the reproduction of goods and services, in agriculture, in solid minerals, in ICT, in manufacturing. It is the private sector. So you need to leave space for them to take advantage of the infrastructure, the enabling environment you are creating. So they need to have access to domestic funds easily. So government is strategically leaving space for them by focusing on external borrowing. And because of the low average cost of external borrowing, the impact on our debt service is minimal, because our external borrowings, the existing ones, over 75%, are for 40 years with 10 years moratorium, with interest rate of about 1.25% per annum. The new ones we want to borrow, because now we're a blend country. We are no more a pure either country. We are moving towards a middle income country, more or less. So we're a blend country. Even the new borrowings we are going to do, the tenors range from 20 to 30 years.
It's very important that you talk about debt servicing, because I recall that only recently the Minister of Finance, when they were looking to have the CBN lower interest rates, talked about debt servicing being a huge part of it. And one of the concerns she raised was the fact that if we did not, if the CBN did not lower the interest rates, the federal government's debt servicing will continue to increase. So it is significant that you mentioned that.
The minister was quite right, because interest rates in Nigeria are high. But the interest rates in Nigeria are high because you look at the structure of price formation in Nigeria. And the simple logic of price formation in Nigeria is that there's inflation. Inflation is high. And if inflation is high, the monetary policy rate has to be high. And if the monetary policy rate is high, that's the minimum lenders can use, the markup on the monetary policy rate. So the question is, if the beginning of the problem is that there's a high rate of inflation, what do you do to inflation? And that's why we are talking of infrastructure. What is one of the major obvious causes of inflation in Nigeria? It's structural. It's cost push. It's based on the fact that there's a huge infrastructure deficit. So whatever you... let me give you a very simple example. Nigerians should know this. Again, let me take Zaria. That's my good example. You produce tomatoes and particularly potatoes in Zaria. You are a farmer. You load 10 trucks. you're on your way to either Onitsha or to Lagos or to Port Harcourt. Because the roads are so bad, somewhere, before you reach any of these destinations, 3 of the trucks will collapse. The trucks carried them will shatter into pieces, and the goods, of course, will perish. So you have lost 3 trucks out of 10. When you reach your destination, you are going to sell the remaining 7 trucks at the cost of 10 as a producer. That's inflation. You are selling 7 for the price of 10. Now, this is a simple example of how inflation forms. Why are you selling 7 for the price of 10? It's because the infrastructure is deficient. And now the same thing happens with power, with rail. So all the totality of infrastructure, because of the deficit, are the major source of inflationary impulse, which now transmits into higher price, which transmits into higher interest rates. So we have to get the logic of how it flows. So the fact of the point that of focusing on infrastructure through external borrowing is in itself an indirect way of unwinding that process of price escalation, bringing it downwards through infrastructure, start winding downwards.